The United Kingdom is caught between two problems at once, and that's making life very difficult for the Bank of England. New data shows the UK's payroll count falling, while consumer prices are rising at the same time. Economists call this stagflationary pressure. It is one of the most uncomfortable situations a central bank can find itself in, because the tools designed to fight inflation can make a weakening job market worse. Here's the core tension. When inflation rises, central banks typically respond by keeping interest rates high or pushing them higher still. Higher rates make borrowing more expensive. That slows spending, and in theory, it cools prices. But the same tightening puts pressure on businesses. They hire less. Sometimes they cut staff. When payrolls are already falling, that pressure doesn't just slow the economy, it can deepen real pain for workers. The Bank of England has been managing this tension for some time. After the pandemic, inflation surged. The energy price shock tied to the war in Ukraine made it worse. The bank responded by raising rates aggressively. More recently, policymakers have been weighing when and how fast to bring those rates back down. That question just got harder to answer. A fresh drop in payrolls alongside a pickup in inflation pulls the bank in two directions at once. Cut rates to support jobs, and you risk letting inflation run. Hold rates high to keep prices in check, and you risk pushing more workers off payrolls. For households, this is a double hit. Fewer people on payrolls means less income flowing through the economy. Higher prices mean that income buys less than it did before. Consumer confidence tends to weaken under those conditions, and when confidence falls, people spend less, which can slow growth further. It becomes a feedback loop that's difficult to break. The UK data also matters beyond Britain's borders. Several major economies, including the Eurozone and the United States, are still navigating their own post-pandemic inflation cycles. The UK often offers an early read on dynamics that show up elsewhere later. If stagflationary pressure is building in Britain, other central banks have reason to pay attention. Markets and policymakers will be watching the Bank of England's next meeting closely. Any signal about how it plans to balance these competing pressures will move markets, not just in London, but globally. The practical takeaway here is simple. When a central bank faces rising inflation and falling employment at the same time, there is no clean move. Every decision involves a trade-off. Understanding that tension helps explain why rate decisions take longer, why central banks speak carefully, and why market reactions can be sharp when the outlook shifts. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.